Hey everyone, it's Ed Kime, CEO over at Quantcha, and welcome to the November 1st, 2015 news and update videos. It's been a few weeks since we've gone through one of these, so there's a few features to catch up on and lots of cool stuff coming in the near future. Let's start off by digging into some of the new dashboard panels that we have. We've added a couple things here. The first is we've added in 52-week highs and lows. These are going to be stocks that are trading at or above their 52-week highs or below their 52-week lows that you can easily find and then read into those what you will and then be able to get to some option trades based on that. It's some pretty cool stuff and it's pretty easy to get to. So just as an example on the dashboard here, we can see 52-week highs and 52-week lows right up near the top. We're recording this after hours right now. At this point, all the company data has been updated, so they're all zeroed out. But first thing tomorrow morning after market opens, you'll start to see these guys populate with what's going on in those places. Second thing that we've done is we've added in the implied volatility, the 10-day implied volatility for the earnings view. This is just one small thing that is representative of some changes that are upcoming. So in this case, when we click through for upcoming earnings announcements, it's going to go out and it's going to pull in just all the earnings that are coming up, which at this point is something like 700 in the next few days. And we can see here that it's sorted by the day and then the aftermarket close, and you can see we've got a few of these here. So we've got the 10-day implied volatility for these guys, and some of them, like for example, Arena Pharmaceuticals, over 100% implied volatility for the 10-day term. And if you're looking to sell or if you're looking to buy in on trades that you think, maybe you think 25% is a little bit too low for American International, you'd be able to come in and find those pretty quickly and pretty easily. Just one nice thing to make it easier to get access to those guys. Another thing we've done is we've got a few new company term metrics, including historical volatility, which is, as you'd expect, it's the volatility over a given term. And I'll give you an idea where this stuff fits in a second in the demo. But we've also got put-call ratios that we're sprinkling throughout the platform, and I'll show you that in a second as well. We've got forward prices that are also added to the term metrics. Now, for all these, we're showing them based on future terms, based on the end-of-day data from the most recent market day, except for historical volatility, which is using past terms. So switching over real quick, I'll give you an idea for that. Let's take a look at Microsoft. Now, by default, what we used to have here is we just had the implied volatility and we had the expiration. So this gave you a good way to say, in the near term, the implied volatility is kind of high. This is the 10-day, then the 20, 30, 60, 90, etc. And you'd be able to make trading decisions based on where these guys are, and we've sort of smoothed out the curve for you. So you can see that, for example, the 120 term, there's a pretty high level of volatility relative to the 30-day term, which is considerably lower. So if you're placing your trades based on that, you'd be able to. And you can also see now that we've got this historical volatility, this is using these terms that it's showing down here. It's using those, but it's using those for the past terms. So think of this as saying, this green line here for historical volatility saying over the past 10 days, the volatility has been at about 60%. Over the past 20 days, we're looking about 44% maybe. 30 days was about about 38%, and so on down the line. And this can be useful because volatility tends to be mean reverting. So even though implied volatility is actually relatively low for the coming terms, you can see that over the past 10 days, and this is largely due to Microsoft's recent earnings, which was significantly moving the stock upward. As a result, the historical volatility is a bit higher. But what this gives you an easy thing to do is to compare what is the projected 90-day volatility based on the implied volatility, and then compare that with the historical 90-day volatility has been at this point. And because the chart is laid out like this, the 180-day number here means this is past looking for historical volatility and future looking for implied volatility. But it just gives you an idea of a way to look at these things. And depending on the stocks you're looking at, you might see some interesting behavior where typically, like the implied volatility is probably going to be above historical volatility. Now, bringing in forward price, I'm going to overlay this, but then I'm going to hide the volatilities here. Forward price is in a nutshell, it's the break even of a synthetic long trade. And we had another video where we went into this with some depth, but the point being, forward price is a good way to get a feel for where the market expects the stock to trade over this term. So based on the most recent closing data, if you were to buy at the money call and sell a put at the same strike, the break even for that would give you a certain price point that would say, for example, at a 10-day term would be around this, 52.83 or 84 cents, and you can see it kind of trends downward. Now these downward slopes will typically be representative of either market sentiment, which is very possible, but also dividends. And so you can see that because of the fact that dividends that are ordinary don't necessarily they don't get adjusted for in stock prices, especially around the strikes for options, what you'll see is that the price of the stock is expected to go down the amount of the dividend. So as time goes on further down the road, you're going to see for any stock that gives out dividends there to be kind of this quarterly downward trend. But this is important as well because if the stock were trading, for example, at this point we're at 52.64. If you saw that this was at $40 a share or $45 a share, that would be an indication that the stock is under a lot of short pressure and is probably hard to borrow, and it would help you shape your view on that particular stock. So let's also take a look at this put call. We'll get into the put call ratio in a second, but just so you're aware of it, we've got put call by open interest as well as put call by volume, and you'll be able to see what those rates are for the particular stocks. And we also have down here the overall put call by volume. So this is if you took all the outstanding options, what the put call is by volume and the put call by open interest for Microsoft right now. And these numbers are based on terms. And so this is saying that, for example, if you were to interpolate the 5-day and the 12-day, you'd be able to come up with a 10-day implied a 10-day put call ratio by volume and by open interest, and be able to kind of evaluate how the market views those over this term and then over this term and all the way down the line. So you can see that, in the long run right now, the put call by open interest is a lower ratio than the put call by volume once you reach this 105-day mark. And so you can interpret this as you will, and we'll get into the details of the put call ratio a little bit more now. So the idea behind a put call ratio is it's calculated by taking a quantity of puts and then taking that under the same metrics, a quantity of calls, and then just dividing the puts quantity into the call quantity. So since the calls generally outnumber puts, what you'll see in the market, and this is just sort of a function of right now trader psychology, is that 0.8 is typically around neutral, and then as you move downward, you will see that as you reach towards the 0.6 mark, you'll reach like a bullish sentiment peak. And the bearish sentiment peak is if you move upward towards 1. So think of it as saying if there's 3 calls to every, rather 3 puts to every 5 calls, it's considered fairly bullish, whereas 1 put per call is considered bearish. However, it does become a contrarian indicator because at the extremes, what you'll see is that it becomes bearish below 0.6 and then bullish as it approaches, or rather as it passes that 1-to-1 ratio. So again, you read into it what you want, and you need to understand the stocks you're dealing with and the behavior of the put call ratios that they tend to have over their lifetime, because certain stocks have certain signatures in the way their put calls trade over time. We track 2 of them. One of them is by volume, which is simply where we take the number of puts traded in a day and divide it into the number of calls, or divide it by the number of calls traded in a day, and that gives you insight as to the sentiment on the most recent trading day. This, of course, can be very volatile because there are intraday sentiment swings. So today there might be a much more bullish sentiment on the stock, and tomorrow might be much more bearish. And this could be due to day trading or anything, anytime when you have a high volume traded on one side or the other. Now, to sort of smooth that out, the other side is we track by open interest. And the open interest is the number of contracts that are held open at the market close, which is regardless of when they were open. So if there was no volume in a given day, but there was open interest, that open interest would still exist when the market closed. Because it inherited from when the market opened. This is good to provide insight as to the overall sentiment of the market, because if people are holding on to their calls or they're holding on to their puts, whether they're long or short, they're doing that because they feel that those are still good investments, as opposed to day trading, which is probably a bit more speculative when you think about the short-term view of a stock. And as a result, they're not really as volatile unless there's a major swing in the sentiment. And now we also have a couple new model metrics, which are taking the intraday put and call ratios by the volume and the open interest and providing those into the UI. So if we were to click through on one of these dates, like let's take, for example, just arbitrarily taking December 11th for Microsoft and pulling down the data for it. If we expand this out, you can see we do have this information here. Our volume numbers have reset because of the timing of the day, so it's actually zeroed out right now. But you can see the open interest right now for that particular expiration for December 11th. We could see there's the puts are outnumbering the calls. It looks like 7-4 about, and so you see a lot more interest in people holding on to puts versus those who are holding on to calls. And again, it is all about how you read into it, because a high open interest or high volume in calls or puts could be long or short. These metrics don't take into account how they were opened or what the explicit sentiment was in when they were opened. So again, another thing to keep in mind based on the nature of how those particular stocks trade. So this is a quick pass through some of the features that we've got out there coming through the deployment this weekend, and we've got some great stuff coming up in the coming weeks, so stay tuned. And as always, if you have any questions, please hit us up at hello@quantcha.com. Thank you.